Welcome to Lesson 1. In this lesson, you're going to learn how to interpret your pay stub and calculate your tax estimates for federal tax purposes. You will know you will be successful if when you are finished with this lesson, you can look at your pay stub, find your taxable income, and then make a rough estimate of what your total tax liability would be at the end of the year and compare it to what's being withheld to determine if you're on track. So our objectives are to understand the difference between gross and net pay, and especially taxable gross pay, and then to calculate taxes withheld and predict annual withholdings and annual tax liability. Let's go ahead and look at a pay stub and look at the key components of this pay stub. In the top of the pay stub, you have all your personal information, but I've circled some of the things that are more important for us when we're making our estimates. Number 1, we have our marital status and our tax exemption. This tax exemption is something that you have claimed for your employer on a form called a W-4, which we'll talk about in a little bit. Your marital status is important too, because depending upon how many exemptions you claim, the combination of that and your marital status, whether you're single, married, head of household, that'll change how much is withheld for federal tax purposes. Then I have the pay date here, or the pay period end date. This is going to be important because you'll need to know how many times a year you're going to be paid if you're going to make an estimate. A couple other things that are important are total gross and taxable gross. Back in quarter 1, we talked about total gross and we talked about net pay. Down here at the bottom, you can see your net pay. You learned that the net pay is what you actually bring home in your pocket, and the gross pay is what you actually earned. You never really get your gross pay, because you're always required to pay some taxes like Social Security and Medicare. But now we have this extra category called taxable gross. The taxable gross is what's reported to the IRS as far as the amount of your income that's taxed. Notice that even though you earned over $1,400, you're only taxed at 13 something. So part of that amount that you earned is not taxed. Why is that? Well, employers often have retirement plans. If you contribute money to a retirement plan, that money can come out of your income before the rest of your income is taxed. In this case, if we look down here at the bottom under deductions, we have a column here that says pre-tax, yes or no. Well, in this example, this employee is contributing to a credit union, $50 for something. That amount is not pre-tax. But then we have a tax shelter annuity, and that is pre-tax. And if you'll notice, that amount is $50. The difference between $1,433.85 and $1,383.85 is exactly $50. So this employee is having $50 put into a retirement plan that is not taxed. There are sometimes other things that are not taxed. If you contribute premiums to health insurance or dental, there's sometimes an option to have those come out pre-tax as well. Okay, a couple other things then that we need to notice is that in this column on the right is we have a year to date. So this is what we have earned year to date. Notice that each paycheck amounts to about $1,433, and we have earned a total of $28. So that means this is only our second paycheck of the year. Our pay period ends January 25th. So how is this employee being paid? He could be paid twice a month, which would then mean that there are 24 pay periods for this employee, or he could be getting paid every other week. Well, there's 52 weeks in a year, so that would then be 26 pay periods. Well, based on the fact that the period end date is the 25th, I would say he's probably being paid every other week. And so in this case, we'll say that he has 26 pay periods. That's going to be important when we are calculating or projecting what this employee will make by the end of the year. We also need to look at our tax amount. We're especially concerned with our federal withholding. We need to know how much is being withheld every paycheck and how much has been withheld so far. We don't care about Social Security or Medicare. Those are required. And we're not taxed separately other than what our employer takes out of our paycheck. All right, I think we're ready. Let's go ahead and do some quick calculations. What I've done is I've pulled some key pieces of his paycheck or pay stub off onto a separate area for us. Here's the amount of his taxable gross and his year-to-date taxable gross. We also have the federal tax withholding amount for this check and the year-to-date amount. We know that the pay date was January 28th, but that his pay period ended January 24th. And we said that there are 26 pay periods in the entire year for this person, but that he's already been paid 2, so he has 24 pay periods remaining. This person is single and claims a tax exemption of 1. That's informational. So I've pulled here a single schedule for this year. Over here is just a screenshot of a tax table. Remember that we can use either or. In the back of your tax instruction booklet, when you go to fill out your taxes, you will see both, and you can choose which one you'd like to use. We're going to go ahead and use the schedule and do a calculation, but remember that this is always an option as well. All right, in order to determine and make an estimate for our federal tax liability each year, we need to start with 1, determining how much we're going to make, and 2, determining how much is going to be withheld. Let's start with step 1. Let's find this person's total taxable income for the year. So we look at our taxable gross, and we look at our taxable gross year to date. So no matter what, this person has already earned $27,6770. But we need to add to that $13.83, this is what they make per pay period, times the number of pay periods left. We just said there's probably 24 pay periods because we're assuming this person gets paid every other week. All right, once we simplify this, we will have this person's total taxable income. When I put this in the calculator, I get a total income of $35,980.10. That is this person's projected taxable income in a year. All right, let's move on to step 2. In step 2, we're going to estimate how much federal tax is going to be withheld based on the tax exemption that this person claimed and the marital status. Well, so far he has had $329.88 withheld, so we can include that. $329.88 plus this person has $164.94 withheld, and we've determined that each pay period, and we've determined there's 24 remaining pay periods. Okay. Again, simplifying this in the calculator, we get total projected tax withholdings of $4,288.44. The question is then, based on a projected income of almost $36,000, is this amount of federal tax going to cover it? What is this person going to owe? That's where our tax schedule and tax tables will come into play. Notice that I put a green arrow here under this category. If this person is projected to make $35,980, that's going to fall in here. So if that's the case, then we know that he is going to owe, or she, $4,090 plus 25% of any amounts over $29,700. That then brings us to step 3. We need to calculate this person's tax liability. Using the table to help us make an algebraic expression, we know they're going to owe $4,090 plus 25% of the amount over $29,700. Well, we're projecting this person will earn $35,980, and I'm going to round. I'm going to leave off this 10 cents. It's immaterial and insignificant. And then I'm going to subtract the $29,700. Okay, in my calculator I'm going to subtract these, multiply by 0.25, and then add 4,090. When I do that, I get a tax liability of $5,060 $660. Well, that's definitely more than the projected amount that he will have withheld, but how much more? So let's do this. Let's go ahead and subtract the amount that's projected to be withheld. And again, I'm going to just round and take off the 44 cents minus 42.88, and I get 13.72. So for this person, they would have to think, is 13.72 a reasonable amount to have to pay the IRS April 15th? If it seems like a lot, then this person needs to change their exemptions from 1 down to 0, and we're about to talk about that. Or if this seems okay, then this person's on track. So let's go ahead and look at how we do that. Whenever you start a new job, or you can do it at any time on your current job, you fill out a personal allowances worksheet to help you fill out your W-4. Your W-4 looks like this. Notice that you put in all your personal information, and then starting here at line 5, total number of allowances you are claiming. And then it says from line H or above, or from the above applicable worksheet. Well, that's this worksheet. You can choose to fill this out, or you can just make a rough estimate of how many exemptions you'd like to claim. So the one thing that you have to keep in mind, and this is where people often have confusion, if you claim 0 allowances or 0 exemptions, you are going to have the most amount of federal tax withheld from your paycheck each pay period. The more allowances or exemptions you claim, the less federal tax you're going to have withheld. What is an allowance? What is an exemption? Well, notice here, this worksheet helps you to think about that. You automatically get 1 exemption for yourself. You also get 1 if you're married and only have 1 job, your spouse doesn't work, or your wages are fairly low. You also get a 1 for your spouse if you're married. You get 1s for your dependents. If you have 2 children, you get 2. There are other things on here too that increase your exemptions. In the end, when you add up all the exemptions you list here, that becomes your total exemptions, which then you put over here on line 5. All your employer cares about is what you put on that line 5. So if you put 10 exemptions, your employer is not going to withhold very much federal or state tax. If you put 0, they're going to withhold more. Your filing status matters too, because remember there's different tax rates depending on if you're single, married filing, joint. So if you put single or married with the 0, it's going to be a different amount. Single, if you are single with 0 withholdings, that's the maximum amount that you can have withheld. If you put married and then you put 10, not much is going to be withheld. There is this box 7 here. You can claim an exemption. Most students claim this. So you can write exempt here, and that means no federal or state taxes will be withheld. There are 2 conditions for you to be able to claim exempt. Number 1, last year I had a right to a refund of all federal income tax withheld because I had no tax liability. So the key is no tax liability. And this year I expect a refund of all federal income tax withheld because I expect to have no tax liability. And you're probably wondering how it is that you could have no tax liability. And we'll look at how the federal income tax return works in the next couple lessons. But basically, if we go back to our example here with our taxpayer, we just assume that his taxable income is what he would be taxed on. But when you're filling out your tax return, there are certain things that you can also deduct from that to come up with your adjusted gross income. And we'll be exploring some of those deductions. But just for an idea, if you have children, you get extra exemptions. If you own a house, you also get extra deductions. So this $35,000 is a conservative number. This tax right here, $5,660, would probably be the most that this person would owe based on this income. In fact, this person would probably owe a little bit less. All right, that concludes our lesson today on interpreting your pay stub and making some tax estimates. So again, remember, to be successful after this lesson, you should be able to look at a pay stub, find the taxable income or the taxable gross income, and then use that in conjunction with the pay date and the amount withheld year to date to determine or predict your total income at the end of the year, as well as do the same thing to predict and determine your federal income at the end of the year. and then use that information in conjunction with your understanding of how to calculate your tax liability to determine if you're on track or you should change your exemptions. So going back to this scenario we had, if this seems like a lot, he would want to change his tax exemption to 0.